Let's say you have a huge cash surge. You've got a check for $12,000, $50,000, even $100,000. Could be the sale of an asset. It could be a refinance. Money in hand, what do you do with it? Hi, I'm Justin Hitt with Sustainable Wealth Secrets. This call is about what you should consider before you pay off debt. Because, I know you could get, if you got a bunch of cash in hand, you've had this cash surge, you've done a great marketing campaign in your business, maybe you sold an asset, and the money sitting in your hand, it is going to burn through your hands if you're not careful with it. All affluent individuals have a lot more desires than they have money, just like a poor person has more desires than money. The only difference is that you're going to take the steps that I share with you today. In fact, there's 7 considerations from what you do with a cash surge in relation to debt. You're going to consider these things because debt is a negative earning. Now, again, we've talked about in other programs, it is possible to have debt on something that generates a positive net cash flow that is greater than the obligation or the coverage for the particular loan. So, example, if you had $1 million loan and you bought 10 $100,000 houses, the potential is better than if you took $1 million loan and bought one house and lived in it. 10 houses to rent out, one house to live in. My kid says, well, why not 100 $10,000 houses? I said, well, we could buy an apartment building. But my point being is debt isn't bad, but it is a obligation or liability to your overall wealth. It counts against your net worth. Now, again, if you have assets that cash flow, then you can have the debt temporarily to secure the assets that cash flow, apply your value-adding activity, increase that cash flow, use the cash flow to remove the debt, and you'll still have the underlying assets equal or greater to your initial liability. I know it sounds like a lot of stuff, but again, you've got this cash. There's $12,000, $50,000, $100,000 in cash. God forbid you've had a relative pass away, or a spouse or significant other, and you're under emotional distress, money in hand from a life insurance policy, and then all of a sudden out of the woodwork, people are asking about your money. What is the safest thing you can do? The most responsible thing, the thing that's going to protect your long-term interests? Well, it is very often first doing nothing with the money while you then think about, number one, eliminating debt to give you personal freedom. If a relative or somebody has left you money, they have done this to preserve your well-being. They're dead. They didn't do this for them. They've done it for the preservation of maybe a family asset, such as a family farm or an estate. It might be to protect your interests. A young father dies. That young father wants to know that their child will raise up and be able to go to college. They'll be able to go to do the things that they need to do in life. They aren't leaving behind trust funds so the kids can go get strung out on drugs. So here's the thing. You've got this lump sum. The safest thing you can do with it is nothing at all, but that's going to wear off because you have inflation. So you've got to be thinking about, what are we going to do? The next safest thing you can do, and a long-term safety thing that will build your sustainable wealth, is to remove or eliminate debt. Now, what are we going to consider? Well, first off, we're going to consider the impact on your cost of capital. That's right. You're going to calculate your cost of capital. And at any given time where you have any debt on the books, you're going to know your cost of capital. Why is that important? Well, let's say your cost of capital is 17%. That likely means a lot of your you got credit card debt, you've got higher debt, consumer debt, and now you have a windfall, and you want to reduce your cost of capital. So you're having no problems paying the payments. In fact, you're thinking, this money could be a down payment on our rental property. It could be a down payment on something. Wait a second. Are you able to reduce your cost of capital? If this money reduces your cost of capital, that means you're paying less money to use other people's money. Your tax on that money, your obligation on that money is less. So can you use this new money to either pay off higher interest debt, or to refinance debt, or to otherwise reduce your cost of capital? Next, you're going to consider the impact on free net cash flow. There are methods or approaches to paying down debt that actually doesn't pay down the cost over time as much, but it increases your available free net cash flow, which potentially helps you pay off the debt faster. I know that's a complex one right there. That's one that a lot of people ask a lot of questions. And when we're sitting down with an affluent business owner who has debt in their home, maybe they have a mortgage on their home, maybe they have debt related to the business, maybe they have a little bit of credit card here and there, we ask the question about free net cash flow, because very often if they have no free net cash flow, debt will increase. If they have a low free net cash flow and a lot of debt, often it's because that money's going towards payments. So can we apply this money to free up the largest amount of free cash to handle the problem that's causing their debt to increase and to give them a little bit of relief? So free net cash flow is important. The next thing is, number 3, the accuracy of the records. Now, the practical nature is you pay off a loan. Very often you don't have access to those records, and then you don't have anything to really know where the debt went. So a credit card, you pay off the credit card, you cancel the credit card, you no longer have access to transactions. A legal activity comes up. So say somebody's suing you, you're going through divorce, you're having a financial discovery for some reason. There was fraud that you didn't know about. Now you know about it. Are your accounting records up to date to be able to look into that account even though you no longer have the account? Very often you can do this by downloading the statements, but ideally you want to know that account is settled, because no sense paying off debt in full that you don't owe. And as I always say, the best protection against identity theft is good and accurate bookkeeping. Number 4, will this application of free net cash flow or this application of this lump sum payment that you have change your tax situation? Okay, so I've worked with clients, and now remember, I'm not a CPA, I'm not a financial planner. I do strategic decisions when it comes to the financial side of your business. So I'm the strategic researcher for your comptroller. Okay, I'm not your accountant, I'm not your CPA, I'm not your financial person. I take scenarios and I grind down the numbers and I help you determine which scenario is best. And what I've seen sometimes for affluent individuals, high net worth individuals, is they have this cash comes into them as an individual. And they have some choices. They have some rental properties. They own some land or a farm or something. They have a business. They have investments. Which of these channels should this money go down? Well, they're carrying a bunch of debt in the business, and they're carrying a mortgage. Let's say they have $500,000 in the business and $500,000 in the mortgage. And let's say they're both the exact same interest rate. Which one should he pay off? Well, the debt in the business has an after-tax cost of capital that is lower, even though the interest rate's the same, that is lower than the debt in the personal ownership. And they might be saying, well, this is my mortgage. I got a mortgage deduction. Okay, well, let's calculate based on your tax rate, which is better, the mortgage deduction or the business value of your payments on debt in the business. So you've got this money, and again, I know the feeling. It is burning a hole in your hand, and then you got this $12,000 that you didn't expect, and it's going in the bank, and you're like, yeah, I got some extra money. I got an extra $50K. Auntie so-and-so died, and she left us $100,000, and we need to honor her name by going out and getting a new boat. That's not what you do. I understand those feelings. That's why I gave you these 7 steps, and understanding your tax situation is important. It is possible you owe money on this windfall. It's also possible that where you apply this money could change your tax situation and make your overall long-term cash flow reduce. See, this isn't a 1 of 7. You consider each one. This is a network of decisions that helps you make better choices. In the case of a business has $500,000 in debt at a certain interest rate, and you have a $500,000 mortgage at a certain interest rate, it is most often better to pay off your personal mortgage. Now, this is going to blow your mind. Pay off your personal mortgage and then reduce your compensation from the business so that your taxable income is lower while handling the debt with the free net cash flow in the business. So again, let's say you're bringing home $10,000 a month and you don't really need $10,000 a month for your household expenses because you paid off your mortgage. So you talk with your CPA, financial advisor, you lower your compensation. Now you can lower your compensation and still get the same amount of money. How would you do that? Well, you lower your compensation by putting more money into your qualified retirement account. That lowers your tax rate by whatever amount you were getting from the mortgage deduction. Now you're even on the household side. And then in the business, the interest is deductible in the business. So you haven't lost that deduction, which actually increases your value because your business is taxed based on net capital. Now, your situation may be different. I'm just giving you a scenario because, again, that money in hand, you have to make decisions about it. And by considering your tax situation, you know what's best, especially if after you look at that scenario, so you know what, that's perfect for me, but you didn't ask the question, do I have enough in reserve to pay my quarterly estimated taxes? Is the tax code changing in the next couple of months? Now, I know a lot of you folks are saying, well, I don't really go into that much detail. You should, because having a large amount of money does add additional considerations. You know, it wouldn't hurt you if you just go out and snort up the whole 12,000 in cocaine and hookers. Maybe it's not really going to hurt you. But then again, you got more to lose than somebody on the street who finds it, or somebody who's getting a windfall from the free money from the government. Again, you've got this cash surge. You've got this windfall. You've got this $10,000 grant from the SBA for your business. You've got low doc loans in the business, freeing up cash. You now make decisions based on what's my future liability. In tax is one of those future liabilities. Number 5, the ownership of debt, the structuring. Now we slightly touched on that, but sometimes it's possible to. You've got a handful of money. You invest the money into your business. Then you take a cash distribution from your business. And sometimes that's better. You're saying, well, Justin, I already had $50,000 in hand. Why would I put $50,000 in the business? Well, you're converting the $50,000 into share ownership of the business and then using the $50,000 to pay back an insider loan. That's structure. Now, again, I'm not giving you that specific advice because there are tax considerations. There are things that you'll sit down with a CPA or qualified investor. You'll have your controller run some numbers on it from the tax perspective. When I build out scenarios for high net worth clients, for corporations, for organizations that need to consider the financial impact of decisions, they will use the scenarios I produce. I throw them together based on the facts that they provide, the information about their situation, the understanding of their process, and then we collaborate to finalize the numbers, and then we look at what has best value. There are situations where you don't want to completely own something. Maybe there's a relationship factor, so the debt, it's partner debt. And so you are a co-signer on debt inside of someone else's business. And you're thinking, well, you know what? I could just buy this out. I could pay it out. And that way I could get out of being a co-signer. Well, what if that being a co-signer helps you have some decision control in that business? It might be better to invest this free cash you've got in the business to get you out of co-signer, but get you into equity. Again, these are solutions. This is how sustainable wealth is created. It's created through a unique perspective, and I'm trying to demonstrate to you that you can use 7 factors, and there are more factors depending on your situation, but you could use these 7 factors to draw up a scenario on a piece of paper. Run it by your tax person, run it by some tables in the IRS, run it by your free net cash flow projection or your pro forma cash flow projections and your free net cash flow actuals over the last couple of years. Number 6, reducing high interest debt. Now, if it's just debt in your personal or debt in one entity, usually taking any surges of cash you have, putting it towards the highest interest rate is the best deal. That's going to free up. It's going to reduce the amount of money you spend. It's going to lower your cost of capital. But again, you need to consider, do you need a cash reserve for something that's coming down the line with your planning, your overall planning? If I pay off this debt in full, do I risk losing so for a line of credit, for example, you pay off the line of credit in full. Do I lose access to the line of credit? See, a lot of high credit terms, if you pay it off completely and you're not sending a little bit over there, they're not reporting to the credit agencies and you're not improving your credit score. If you pay it off completely and it stays open and idle for a while, sometimes they'll close the account and then you won't have the funds available if you need them. A lot of things to consider. Of course, your unique situation, reducing the high interest debt does give you better value. Number 7, and the final one for this podcast, is the cash opportunity value. There are times that I sit down with a client or I'm looking at something because an accountant had sent me the information over to give it a strategic overview, where literally every loan in a portfolio. So I was looking at this investor's investment portfolio. Every loan in the portfolio, they're getting 1-to-1 or 1-to-2 matches on cash flow over their debt obligation. So that basically means, let's say you had 100, the example of 10 houses at 100,000 each. If that $100,000 house produces more revenue than the obligation for payment. So the payment's $700 a month. The contributed overhead related to it is $300 a month, and you're getting $1,200 a month in rent. How many of those can you have? Well, you can have a lot. You can have thousands of properties that all produce $200 a month in free net cash flow, and it has to really be free because the activity covers the obligation. Now, of course, I'm going to come in. I'm going to be the jerk that says, well, this is a good market today, but what about in the future? Because you want to look, one of the values that I deliver is I'm looking at historic, current, and future, and then helping you bridge the three with a strategic plan. So I'm going to say, well, you know what? You might have 100% rent right now. You might have 100% rent in the last 3 years, but it wouldn't hurt to project at an 85% occupancy. So let's say you have coverage at an 85% occupancy, then you don't need to pay off that mortgage. It doesn't give you any value. If you were to pay it off and then refinance later, you're going to have to pay closing costs. And so will have to pay money to get access to your equity. And you already got the equity in your hand in the form of this windfall or this cash payment that you've got. Where else could you invest that money to get a similar deal? If you've got a few properties and they're all cash flowing positively and your books are accurate and the tax situation's clean and the cash flow is good and the accuracy of your records can prove these things and you ran it by your advisor and your advisor says, yep, that's what it looks like, and you got a low cost of capital, then you need to be taking that cash and putting it somewhere where it can grow for you. So maybe that cash becomes a down payment on another property. Maybe it becomes an expansion in your business. What would you be able to earn there? And so, for example, in some markets, you're paying 2%, 3% on a loan, and you're making 5 to 10% in the marketplace. Well, why pay off the loan? So we often do analysis on cash-on-cash returns, free net cash flow. It just depends on the type of investment. How much money are you making? What's the percentage relevant? The comparable percentage of your positive growth on assets versus your negative growth on liabilities. Factor in some inflation, factor in the tax world, and you can now make a decision that this money can be growing for me. And I know you want to buy a boat with it. I know you want to treat yourself because you've been working so hard. But very often we can do deals, and I'll give you a quick example, is that we can take a small amount of free cash and increase your cash flow. And so we'll use $12,000, for example. I'm working with a client right now where we're taking about $12,000, applying it to their debt load in such a way that frees up $600 a month in cash and free net cash flow. So we're basically eliminating some short duration, high payment debt. Now, the interest rate on this debt is really good. I wouldn't do it. There's a good tax value to this, but the payments are $695 a month for this combined little bit of debt, and that we only got $12,000 to work with. So if we take that $12,000 and we divide it by $695, I'm just going to say $600. In 20 months, they've got the $12,000 in cash back. Do you see how this works? So they could take that $12,000 and directly apply it to an opportunity that generates additional revenue, keeping the original debt, but they want to be in a secure position with a lower obligation to debt. And so the $12,000 in cash removes $600 in payments. And in 20 months, they're going to have their original $12,000 back. Because you know what? Maybe the opportunity right now isn't as good as it seems. And they want to spend a little time to see what's right. Maybe you did your analysis and you look through all this stuff and you really don't know what's going on because you're not really sure about the situation. You want to give it some time. Well, instead of losing money on that cash in your bank account through inflation, through potential identity theft, through buying that damn boat, four-wheeler, or motorcycle that you've always wanted, you've now applied the cash somewhere that frees up your net cash flow and then ultimately recovers the original money. So if you think about it, you didn't really lose the $12,000 paying off the debt. You've just kind of spread it out a little bit and receive it back over time. Now there is, I do know future value of money. There is a little loss to the money. That's why I went from $695 to $600 because there's a little bit of loss to the money over time. Because in 20 months, it's almost 2 years. You're going to lose a little bit. $12,000 today is worth more than $12,000 in 2 years. Now, again, I've covered a lot in today's podcast. Some of the concepts here are abstract and they are a challenge. Even sitting down with your tax attorney, even sitting down with your comptroller. And that's why people like me, analysts, come in and they build out scenarios. And what I usually do to make this more tangible is I'll draw it up on a whiteboard and we'll do maybe a cash flow analysis that's a flow diagram. So we'll look at from product sale to profit in the business, where does the money grow? We'll diagram it out. Now, we might also have a chart that represents that, and we might be putting discounts in for different manufacturing costs, and your finance person from one department might give feedback, and a finance person from another department. Long story short, it becomes kind of a binder that's more tangible. We wouldn't do that for $12,000. We would do a smaller analysis and breakdown. But I've worked with clients that, for example, were buying a $23 million piece of equipment. And being able to buy a $23 million piece of equipment in the most advantageous way for the holding company, because they didn't really care how the business did it. They cared how the holding company's doing it, because that's where the money was coming from. We were able to not only get the equipment at a lower price, because how we bought the equipment, we were also able to finance it in-house. So the holding company was able to take money out of the business that they owned in a more tax favorable way. And ultimately the value on paper was much higher. They were able to buy the piece of equipment, not only discounted up front, but significantly discounted over time because of how they purchased it and financed it. And that's what they're really looking for, because it boosted their returns. And as the holding company was publicly traded, that boost in their returns looks good to their investors. And get this, they didn't really buy the equipment. They just held the note and did the paperwork, because this meant to the investors enough that they got about 20, I don't know exact the numbers on how much new capital came into the business, because they were able to demonstrate how good of a steward they were for this money. Now, I don't know your situation, but often these 7 factors will take that cash surge, keep your brain busy, help you build out some scenarios on paper, help you look at it a few different ways, and then you realize that you can still have the boat just a little bit later. Just delay the gratification a little bit, but ultimately you want the value now. You want the asset creation now. You want the ability to increase your net worth now. Because when you do these things, you'll figure out how to get a boat. It's easy. If you want a boat tomorrow, call me on the phone. I'll tell you how to get one for at least the time that you would normally be using it. Because a lot of guys, I don't get it. A lot of folks have that boat in the backyard they haven't been out with for years. Anyway, we do a little bit of converting liabilities into assets. These are the factors you want to consider, because once you have those assets, if you just blow them, it's not a huge benefit. I'm Justin Hitt with Sustainable Wealth Secrets, and this was kind of an extended podcast on what to do with a cash surge, especially when it comes to debt. What things do you need to be thinking about, and what kind of approaches you need to do? And very often, these things can snowball. You get a cash windfall of $100,000 and you can turn that into an easy $50,000 a year for the next 5 or 10 years in just how you applied it into what you do. Now, if you're not doing anything, if you're not making any money, if you don't have a decent net worth, these factors still work a little bit. They're just not going to have the multiples that I've seen with a lot of clients who do. If you have questions about what I've covered today, if you want to see some fancy diagrams, it's going to make it a little bit easier to understand because I understand, we're on audio right now. Please visit www.sustainablewealthsecrets.com. If you contact me by postal mail or by fax, I'll send you an answer to your question and try to help you get in the right direction. Thanks for listening. Again, I'm Justin Hitt with Sustainable Wealth Secrets, here to help affluent individuals and high net worth individuals create wealth that cannot be taken away. In fact, it will grow faster than your ability to handle it or manage it. But with the right insights, you'll be able to do it in such a way to protect you and your family for generations to come. Thanks for listening.